Welcome to our 2023 Economic and Market Outlook video. Thank you all for tuning in. I'm Steve Mahan, Senior Portfolio Manager with the firm, and I'll be moderating our discussion today. To my left is our Chief Investment Officer, Craig McCrory, and next to him is Senior Portfolio Manager, Sarah LeClaire. Now, Craig and Sarah are going to cover a wide range of topics today, but they'll be answering some of the most frequent questions that we've been getting from our clients. We're filming this on December 16th, 2022, and as you've heard before, it's certainly been a rough year. As of yesterday's close, stocks are down about 18%, bonds are down about 10%, and I think understandably so, that's got a lot of our clients asking the question from a financial perspective, am I going to be okay? So I'd like to start, Craig, by putting the question to you. In an environment like this, what should investors really be focused on?
2022 was a very difficult year from an investment market standpoint. For an investor, virtually across all available investment asset classes, with a few exceptions, they've all been negative for the year, which is a very difficult environment. And even when you think about cash, after inflation, we're still looking at negative real returns if you think about where interest rates have come and where they are today. So it's been a very difficult landscape for them. And the first image that we'll share with you today, on any given year, you can see that on the far left-hand side is that market swings are very wide, whether it's stocks, bonds, otherwise. You see very high positives or very low negatives potentially. So in a very short-term time horizon, it's very difficult from an investing perspective because you get these wide variations. But as we go out multiple years on the time horizon, you can see that over time, returns begin to normalize, and it's a more steady and what we would expect over a longer-term time horizon. So when we think about that, what we want clients to focus on is really their goals. So as our colleague Donna will talk about in the next video with us, is focusing on what the plan and the goal is to begin with, and how that interrelates with their investment portfolio and how they're allocated is very critical.
Yeah, okay. So keep your eye on what you're trying to do rather than the short-term noise.
That's right, yes.
Okay. Turning now to markets. I mean, there's a lot of short-term noise out there. So if we look at the markets, I think there's really been three big things that have driven what's gone on this year. You know, you've had inflation, you've had interest rates, and you've had the rising risk of recession. I was thinking maybe we could take each of those one by one. So we'll start with you. Again, Craig, I'd put it to you. I mean, inflation's been the key thing on everybody's mind. What are our thoughts on inflation?
Since the global financial crisis back in 2009, across the world, arguably, there has been little to no inflation. And in some instances, in some sectors such as technology, it's actually been deflationary or a negative inflation environment over the last decade plus. And so when we think about that, the next image that we'll show you here is that since that time, we've actually, if we look at that over an average of a 2% average inflation rate over time, which kind of corresponds with average economic growth for a developed country, is you'll see since that time period, we've actually been below trend for the most part of that time. And as a result of COVID and the stimulus that went into the economy here as well as across the world, we arguably thought that there was an overheating of the economy coming, meaning that demand was outpacing supply. And as we had mentioned at our outlook a year ago, is we felt that over this 2022 calendar year, we would have seen something more normal and bring us back up to an average trend. And what we actually experienced was with the invasion of the Ukraine is we saw a very rapid increase in prices of energy as well as food. And that really accelerated this catch-up period, as we can see here in this image, where inflation went from kind of a below trend average, we thought would be a moderate pace, to a very rapid pace kind of going into 2022.
You almost had like a decade of inflation in a year, like we were catching back up.
Exactly right, yep.
Okay. We've got a lot of clients who lived through the 1970s and remember that well.
Yeah.
I mean, there's a really tight labor market today. There's almost 2 job openings for every unemployed person. I mean, can you contrast today's environment to the 70s and maybe talk a little bit about why we don't believe we're going back to that sort of place?
Yes. During the 70s, if we look at kind of focus on the U.S. here for a moment, is the employment landscape was very different than it is today. So then we had a lot of employment contracts that were unionized. And so therefore, as we started to see an acceleration in inflation, spurred primarily by an energy crisis at the time, is you started to see that there was an auto escalator clause built into these unionized contracts, where if prices were increasing, the wages would automatically inflate along with them. And so it kind of created this spiraling effect where one was dependent on the other. And really when you looked at your expectations of inflation in advance of that, is you really saw that people had a very pessimistic view of inflation, meaning that rates would continue higher forever because you had this dynamic where both were increasing dependent on the other. And that's very different than the landscape today. So when we think about that, you can, if we look at expectations today, and on the next slide here you can see, is the inflation expectations over the next 3 to 5 years are more in line with our normalized trends. So again, that 2 to 4% range. So in that element, it's a very distinct and different landscape when it comes to the employment and also the inflation picture.
Okay, because it's structurally different.
That's correct,
than the 70s.
yes.
And that means not spiraling out of control, in our view, probably coming back to a more normal place. Would you say it settles a little higher in the future?
Completely agree. I think right now we're at the point where we're going to get more of a higher than average trend, but not this accelerating like we've seen over the last 12 to 18 months.
Gotcha, thank you. Sarah, let me bring you in here. I mean, if we are settling higher, well, let me start here. How has inflation impacted our portfolios?
Good question. So not only have we preferred companies who can really pass along those price increases and manage their growth and expenses going forward, but we've also looked to companies who can be flexible and adjust to this higher inflationary environment as consumer spending habits changes. Because as we experience inflation, it starts to hit our pocketbook, we naturally are going to shift and change where and how we're spending our money. Now, if we look at it from more of a sector-specific dynamic, there's what's known as more defensive sectors, and those are going to be like energy, utilities, materials, and financials. But given some of the stresses in the market and the inflation that we've experienced, some of those sectors have performed quite differently than what we would, or what the markets would expect to experience over time. So I'd like to actually bring up a chart for you. This reflects the correlations of the different S&P sector performance in relation to inflation expectations. So if we look at the left hand of the chart, really those dark blue bars, anything above 0, we would expect that those sectors are going to perform positively or favorably in an environment where we do have those more increased inflation expectations. And it's really been interesting because this year has almost been like a year of two different tales. You have the historic trends, and then you have what's actually played out. And unfortunately, it's been a bit distorted in some cases. Some sectors have performed in tandem with their historic trends, and others just haven't. Sometimes we've seen, or often we've seen companies within sectors perform not in alignment with the rest of the sector because of some of those outside pressures going on in the world. And so when we pop the hood though and we look deeper into the sectors, we are finding some attractive areas in the marketplace. I mean, referring back to the chart, if we look all the way over to the left, energy has done really well this year. It's returned, as of this date of recording, about 60%. However, when you look to materials, financials, real estate, those next three sectors, I mean, materials is down 11%, financials is down 12%, and real estate is down 24%. So it truly has been a unique year when it comes to inflation in the markets.
Okay, so maybe not what most would expect what happened in a inflationary environment. Moving forward, Sarah, give us a sense for how we're positioning the portfolio.
Yeah. Well, in the short term, it is quite challenging to determine what risks and expectations are already built into security prices. Because as a reminder, the stock markets are forward-looking. So our team's being really diligent and thoughtful and methodical about how we're managing our portfolio as all of those news feeds, the news headlines, and all the data is coming our way. Now, I think it's important to mention this and just remind everybody that we're not just trading and buying and selling stocks like trading cards. We're investing in businesses that we believe are going to have attractive growth opportunities over the long run. And so when we think about that, we're really focusing on where do we want our sector exposure to be? Do we want to be overweight the marketplace or underweight? And even underlining in the industries making up those sectors, are there areas that we want to have exposure to going forward because we think they're going to be positioned better? Or is there areas that maybe we want to avoid investing in entirely just given the landscape that we're in? And further, looking into companies and seeing where they're earning their revenue. I know, Craig, you mentioned that inflation is not just a problem here in the United States, it's being felt everywhere in the world, so we want to be mindful of that. But I think right now we're all really attracted to companies who have flexibility in their product pricing, those that have opportunities for growth in an inflationary environment, and then also dividend-paying companies. Those have been really attractive.
Okay, thank you. No one's been as focused on inflation this year, more so than the Fed.
Sure.
And so obviously we've been in a very unique monetary policy environment. The Fed's got two objectives. They've low unemployment, which they're doing, and stable inflation, which is not happening. So Craig, give us a little bit of perspective on Fed policy and what that might look like moving forward.
Absolutely. So when we think about Fed policy, really we take it from a global standpoint first. So when we look at this really kind of as 2021 progressed and we started to see this normalization or attempt to normalize demand and supply imbalances, what we saw is once we kind of hit 2022 and we started to see some of the conflict in the Ukraine really kind of spur its head here, is we had this immediate reaction in most developing countries where they had nothing else to do to tame inflation other than to begin to increase interest rates. And what we saw here in the United States was a pretty aggressive response to that. If you look at the next kind of image here, you can see relative to our recent history as far as interest rate hiking cycles, 2022 has been the most aggressive in this short period of time. So it's been a very aggressive response to this. Exactly. And I think that that's exactly what we're seeing. We've all felt that, but here on the visual, you can see it, right? You can see how much different this was. And typically what we see in these types of cycles is we'll see an increase followed by some form of moderation, and then at some point, a deceleration of rates and possibly decreasing rates depending on what's going on. And in this scenario, what we're seeing right now is the Fed is trying to be more transparent. They've made a conscious effort here over the last few meetings to kind of not telegraph, but give us some indication of what they're thinking and what their thoughts are and expectations. And what we're seeing here is, while as of our recording this week, they've increased rates again, it's at a lower rate than they have in the last few meetings. So in this most recent meeting, they've increased at 0.5% versus the last several have been at 0.75%. But we started the year at 0. And now we're north of 4. So in that scenario, it's been a very rapid rise and a rapid change in this scenario. What is the uncertainty of this is how far they continue to go, as well as how long they may prolong that rate at that elevated level.
Okay. So maybe the pace of the increases slows down a bit, and we kind of we find a level to stay at, and we sort of stay there for a longer period of time.
That seems to be what they're showing so far. That's correct.
Kind of that higher for longer.
Exactly.
Right?
Exactly right. Yep.
Sarah, that aggressive rate increase, right, has hurt bonds quite a bit. It's been the worst year for the bond market, and on record, basically. Tell us a little bit about what we've done in the bond portfolio, and maybe what things might look like moving forward.
Sure. So just as you mentioned, I mean, bonds have experienced the worst year from a price performance standpoint that we've seen in a very long time. But what is changed relative to the same time last year is that bond yields are actually at the highest level that they've been in nearly 15 years. As interest rates have increased, bonds and debt are being issued at much higher rates, which means that income generating power of our fixed income portfolio is in a place that it hasn't been in so many years. So for our clients that do have an allocation to fixed income, mid-year we really shortened up that duration, because if you recall, when you have longer dated bonds, there's much more price sensitivity to changes in interest rates, so we wanted to shorten that up a bit, and that's been beneficial for our portfolio. Most recently, we added some high yield exposure in as well, because we're able to get a 9% coupon payment. And what's unique in this period of time is that the rate or the risk of default is actually much lower than it has been in the past due to the credit quality of the underlying issuers. I mean, even take cash, a fully liquid high yield savings account is paying north of 3% right now, which in some cases is more than you would earn in a longer dated CD at your banks. So I think really bottom line, bonds are in a much stronger position to be that defensive component in portfolios, again, looking forward.
Gotcha. Thank you. So bonds are back. It sounds
Bonds
like,
are back.
for the first time in a long time. You just mentioned defense, Sarah, and all I hear in the news all the time is talk about a recession and the risk of a recession, and defense would be needed should one come, most likely.
Yeah.
Craig, give us some of your perspective or your thoughts on the possibility of a recession in the near term.
Yeah, I think we can kind of look right now at Europe and argue that they already are in recession based on what's gone on there in the last year. I think if we kind of extrapolate that out, we can see right now there's inflationary pressures out there, no question, that we're trying to combat right now. But there's also this mixed signal when we're thinking about the economy. So back to that dual mandate here in the U.S. of the Fed, we've got to fight inflation as well as maintain employment. And as you mentioned earlier, is that we're at about 2 jobs available for every person looking for a job today. And in that scenario, that's a mixed signal for the Fed to try to regulate. And so until we get some kind of relief on the employment side or the unemployment side, we're going to have this battle of, how far do we raise rates and for how long, back to that moderation. So in our view, we do think that we're likely headed into a recession at some point here in the near term. And I think in that scenario, we are expecting a mild recession. Nothing as material as maybe we saw or the enduring duration of the global financial crisis, 07 through early 09. So we are expecting there to be something like that, some earnings compression, that kind of thing that we'll experience here over the next period of time.
Not a repeat of like the financial crisis, but
Correct. Yep, that's right. Yep.
And Sarah, from a portfolio perspective, what are some of the things we're doing to position for maybe a tougher economic environment?
While our intent is certainly to be more proactive instead of reactive. I mean, if we think about the markets the same time last year, they were much more expensive from a price to earnings perspective, and they've become much more favorably priced or more fairly priced even in today. And so as we're looking forward, I would say over the last several months, really, we've continued to place trades to really align our asset allocation with our outlook going forward. So that's been increasing some of our fixed income exposure again, but then also adjusting our equity exposure within our underlying portfolio as well. Really focusing on those businesses that are well positioned to weather that storm, whatever it may be, whether it's a mild or something more. We just want to be looking for businesses that have those strong balance sheets, have stable cash flows, and don't have a lot of debt right now.
Kind of fortress style companies, those types of things.
Yeah.
Well, thank you, Sarah. Is there any, you said mild recession.
Yeah.
Are there any risks out there that give us a little pause that could change, that mild variety?
Yeah, unfortunately, the answer is yes. I think we've kind of alluded to this in a couple of different responses here from the economic side. But when we think about one of the largest risks to focus on, it's really geopolitical risk. So of the unknowns that are out there, clearly 2022 was disrupted by a geopolitical event. And so when we think about that and kind of what could be a disruptor for the portfolios looking forward, that's definitely a key one on our agenda and what we're thinking about. And the reality of it is that they're very binary, in the sense that if we see some form of diffusion in Ukraine, as an example, some kind of negotiating, that's a positive. The markets will look at that favorably. However, if we see some sort of escalation in that, whatever that case may be, we don't want to really go down that path mentally, but if we go through that, there's a risk there to the downside again on the markets, unfortunately. And right now where we are, there's other areas of the globe that are kind of suffering through that same scenario. We've got Africa, Middle East, Asia, all those kind of have this binary effect right now because the news flow is so intense. One way or the other, the markets would react kind of in bi-directional depending on where it goes.
It makes sense. I mean, I think we're all aware of tensions being on the rise. Is there anything we could do, Sarah, from a portfolio standpoint to position for rising tensions around the globe?
Yeah. Some of these actions we've already been taking in preparation for just the uncertainty of this. I mean, at the end of 2021, due to some of the regulatory risks, we actually removed all of our Chinese domiciled positions from the portfolio. And even over the last year, we've taken much more of a U.S. stance, meaning we've tilted our allocation that way. And if we look forward, even over the short to near term, we still feel that that's the appropriate path to take, just given some of those geopolitical risks and uncertainty that still remains. And I think longer term, we can all agree that there's a lot of value and opportunity in the international markets, just maybe not at this time. And if we, last year we talked a lot about having the investment opportunity in the emerging market consumer. And I think it's worth noting that just because we have a US tilt in the portfolio right now does not mean that we're giving up access to the spending power of that demographic area. You know, we've worked really hard to craft the portfolio to be inclusive of companies who derive their revenue very globally. So when we look at it all together, we have a really nice diverse base of where companies are earning their revenue from, so that we're still getting exposure to the consumers and their business investment without necessarily taking on some of that country-specific risk that is on top of all of our minds right now. Now, the last thing is that the US dollar has strengthened quite considerably over the last year, and it's been a big headwind for international companies. But as that starts to depreciate down, that's going to really help those companies perform better, and particularly the ones that do a lot of trade with the United States. Now, money tends to flow into the United States when times of stress because our markets are seen as more of a safe haven in the world, so money tends to flow there. But I will say that if you have travel plans or you have a desire to travel internationally, from a currency conversion or a purchasing power standpoint, you should actually maybe consider going and booking that trip sooner than later, because given the strength of the US dollar, you're actually getting a lot more for your money right now.
Gotcha. Okay. So you want to be there without being there investing wise, but when it comes to yourself, you want to go be there.
I'll enjoy it.
We've been talking a lot about risk, but I think when markets are like this, as we all know, if you extend your time horizon, there's also a lot of opportunities. So Sarah, I'd like to ask you, I mean, what are some of the things that we're excited about longer term?
Yeah, well, importantly, we will get through this, and this too shall pass. There's a lot of secular changes happening in the business cycle right now, and what has led us into this environment won't necessarily lead us out. I mean, if we look back over the past 15 years and what has really performed well and led us into this are those more digital businesses. But looking ahead, what's likely to bring us out of this is companies that sell more of those physical goods, meaning they're earning cash today instead of a promise for cash tomorrow. And a lot of that has to do with the increased interest rate environment that we're in. And so, you know, I mentioned this before, and I think it's worth mentioning again, like we're investing in businesses, we're not trading stocks. And it's also important for us to be mindful of the time horizon of our investors as we're making decisions in the portfolio. So over the short term, again, we love those dividend-paying, high-quality companies here in the United States. But longer term, maybe not right now, but in the future, those small to mid-sized companies and international businesses are looking very favorable they're very attractively priced. And so I think you'll likely see us start to continue to increase our allocation there in the future. Probably just not in the next couple of months, but I mean, more specifically, we like energy and cybersecurity stocks, both here in the United States and internationally. There's a lot of really exciting areas in healthcare. If we look at biotechnology, there's a lot of really cool generational innovation happening there. And insurance companies have a lot of great pricing power as their contracts come up for renewal. We like the semiconductor space for a number of different reasons. And again, just those companies that sell more physical goods.
Gotcha. So it sounds like there are opportunities out there. It sounds like there's a good bit
there's
of them
hope
too.
Yeah.
Okay. Well, thank you both. We've covered an awful lot of ground. I think, you know, if I had to summarize this, I think I would summarize it by saying we think inflation is going to be coming down, but probably settles higher. We think rates probably slow their increase, but probably settle higher. And we think there's likely to be a recession, but however, it's most likely mild. And despite that, there's certainly plenty of opportunities out there if you extend your time horizon. So, Craig, I actually want to kick it over to you to kind of close us out here. I mean, you're Chief Investment Officer. What takeaways would you want people to have maybe from this video?
From that historical perspective, if we think about the stock market and focus primarily on the U.S. here for this example, is on average since 1926, so plus or minus around 100 years now, we're averaging about 10.5% per year rate of return. So as a perspective, in any given year in the short term, anything can happen depending on what's going on in current events. But if we think about that over a longer period of time, that's much more average and normalized. So when you think about that though, from 1926 to today, I mean, we've lived through 16 recessions, Great Depression, 2 world wars, the global pandemic most recently. So a lot of things have happened over that time period. And if you just hypothetically were to invest $1 in 1926, it'd be worth $13,000 today. So a very large change there. So to your point, is that time horizon really matters. And as the notable investor Bill Miller famously quoted, it's time, not timing, is key to building wealth in the stock markets.
Very good. I think that's a great place to end it. Thank all of you for tuning in, and be sure to check out our next video module where our certified financial planner, Donna Woodruff, will go over some insights on the value of having a financial plan.